Hey, welcome back. It's Nolan Mathias, and today I want to give you the definitive guide on how to manage your credit in Canada, because you know what? I've been watching the YouTubes, and there's a lot of really crappy information out there. So I want to give you the realities, the hard truths of how to manage your credit, what works, what doesn't, from somebody who's been in the industry for 18 years now and actually understands how credit bureaus work. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit the like button so more people like you can see this video. This one's an important one. And as always, make sure you leave your questions and comments about credit in the comment section below. I'll get to them as soon as you send them. Okay, so let's talk credit bureaus, because this is a topic that is widely misunderstood. We've seen all sorts of bad advice on this topic over the years, and I want to set the record straight on a whole bunch of things and talk about what really matters in your credit score. And I want to start with two fallacies that I see consistently on the internet right now, especially on YouTube. And they are, one, that applying for credit cards and credit card hacking so that you can get rewards is a good idea, because it's not. And two, that you should be using free credit score apps in order to monitor your credit. And this is a really bad idea, and I'll tell you why. But first, let's talk about that first piece, which is credit hacking. Credit hacking is one of the things that can single-handedly reduce your credit the quickest, because quite frankly, there are two things wrong with credit hacking. One is it requires you to be consistently applying for credit, which does have an adverse effect on your credit. We'll get to that a little bit later on in the video. And two is the more credit you have, the more inclined you are to use it, which leads a lot of people who get into credit hacking for things like free rewards into a lot of financial trouble down the road. And we have seen this consistently with clients throughout the years, where somebody comes in and basically has to either refinance or doesn't qualify for a mortgage because they've taken somebody's advice on how to get free things by using credit cards. Let's call a spade right now. If somebody is offering you something for free, whether it is your credit score or whether it is flights or whether it is some sort of reward, there's a reason they're doing it. And it's because they know that if they do, statistically, you are going to end up spending money with them, or in the case of credit cards, you're going to borrow money from them. And that's not just true for credit card rewards programs, it's also true for these companies that offer free credit score monitoring and free identity theft monitoring. These companies are doing that for a reason, and the reason why is because they are using the fact that you are getting your credit score monitored by them in order to get you to eventually apply for credit cards with them, or loans with them, or mortgages with them. Your free credit score is an avenue for them to sell you debt. So stay away from those sorts of companies. So how do you really monitor your credit score? Well, the best way to monitor your credit score is to go to a place like Equifax.ca or TransUnion.ca and pay to get your credit score directly from them. And both of these companies have credit monitoring products. You just have to pay for them rather than get them for free. But remember, it's just like Facebook. If something's free, if you're able to use it for free, it isn't the product, you are. And that's what these companies that are giving you free credit reports and free credit score monitoring are doing, is they're using you as the product so that they can sell you credit cards and loans and stuff down the road. Stay away from those. So once you've gone to Equifax.ca, once you've gone to TransUnion, and you have figured out what your credit score is, and they've told you all the things you can do to improve your credit, well, that's when it is time to take action. Now, keep in mind that Equifax, TransUnion, they're going to have different ways of calculating your scores. In fact, each of those companies has different ways of calculating the score depending on who's asking for it. So the score that you see is often going to be a different score than what the credit card company sees, or what your mortgage broker sees, or what your bank sees. And the reason for this is they just have different algorithms that they use, and different people, different companies subscribe to different versions of the algorithm. For us, we subscribe to what's called Beacon 9. So we see a Beacon score. It is the latest version of a Beacon score, and it has a higher emphasis on certain things than it has on other things. And I'll get into that in a second here when I start talking about what actually affects your credit. So what does affect your credit? Well, there's 5 specific areas that credit bureaus look at in order to establish your credit. They are your payment history, your used versus available credit, your credit history, your public record, and your actual credit inquiries. And we'll go through each one of these in detail. So let's start with payment history. Payment history makes up 35% of your credit score. And what payment history is exactly what it sounds like. It is your history of actually making your payment. So if you're new to credit, generally your payment history is very good, because chances are you haven't missed a payment yet. However, if you do eventually miss a payment, that missed payment will be on your credit bureau for at least 7 years. Now, there's different degrees of missed payments. There's missed by 30 days, missed by 60 days, missed by 90, 180, and so on and so forth. And typically how this is categorized is as an I1 or an R1 or an I2 or an R2. I1, I2, I3, I4, that refers to installment payments. R1, R2, R3, R4 refers to revolving credit. And installment payments are exactly what they sound like. That's when you have something like a car loan and you have an installment payment that you pay every single month until it's paid off. And revolving payments are things like credit cards and lines of credit, where your credit fluctuates as you borrow more and pay it off, and you obviously have the option to pay more down as time goes on and draw more down as time goes on. So an I1 or an R1 means that your payment has been made on time. If you go to I2 or R2, it means that you've missed a payment by at least 30 days. Now, a lot of people believe that if you miss a payment by 1 or 2 days, that's a missed payment and that hurts your credit. That's not actually true. You actually have a 30-day grace period to make your payments before it starts to affect your credit. So if you see somebody who has an R2 or an I2, or if you yourself have an I2 or an R2, it means that you've missed a payment by more than 30 days. So you didn't just miss it on the due date, but you missed it by a whole month after the due date. And that is when your credit starts to get hurt. And those R2s, R3s, R4s, those will last on your credit bureau for at least 7 years. The only way to get rid of a missed payment on your credit bureau is to wait. And it takes basically 7 years. So time is the only cure for missed payments on a credit bureau. And late payments have the biggest negative effect on your credit score, because late payments are the thing that indicates to somebody who's about to give you credit that you aren't reliable. So the number one thing you can do to keep your credit score high is to make sure that your payments always get made on time, bar none. If there's anything that you take away from this video, it is this: make your payments on time and your credit will always be reasonably good. As soon as you miss a payment, that's when you're starting to get yourself in credit trouble. Now, if you get to an R6, which is basically 180 days late, that is basically when lenders will start to sell your loans to collection agencies. They'll basically write it off on their books, and that's when you'll start getting calls from, the collectors that nobody likes to get calls from. And here's the thing about that is, once it goes to a collection agency, it's pretty much considered an R9, which is the worst score you can get for a payment of any sort. And that basically means that you have failed to pay it and the bank has said, hey, we're done with him. And then you end up with this thing that additionally hurts your credit, which is the collection, because collections show on your credit bureau as well, and those have a significantly bad impact as well. Now, the types of things that we typically see on a credit bureau that do a ton of damage to somebody's credit are collections from two types of organizations. One is cell phone companies, and two is ambulances. So if you get into a feud with a cell phone company about whether or not they overcharged you, the best course of action is not to say, I'm not going to pay you. The best course of action is to pay them and then continue to fight them after you paid them, because telephone companies will damage your credit. They have no hesitation in doing so. And it is the number one way that we see people get their credit score absolutely screwed. And the big thing you need to understand about collections as well is you're probably not getting a credit card or a loan until that collection is shown as paid. So the collections agencies know that the chances of you being able to get something like a mortgage are slim to none until you make right on that credit. So they will get their money eventually. So it is best to pay them and then fight them after you pay them so that they don't damage your credit. And by the way, Equifax, TransUnion, you can go to them and say, this isn't fair all you want, but there's a really good chance that if the credit card company, the telephone company, whoever it is, and the collection agency can show that they've tried to get you to make the payments and you haven't done so, there's a really good chance that Equifax and TransUnion are going to do absolutely nothing to help you. So again, make your payments, whether you think they're fair or not, make the payments, make the payments, make the payments. Now, the second thing that affects your credit is your used versus available credit ratio. And this accounts for 30% of your credit score. And in recent years, this has been one that we've seen do a ton of damage to people unexpectedly, because it used to be not as big of a factor, but now it is. And what your used versus available credit ratio shows is your utilization. So if you've got, let's say, a $10,000 line of credit and you're constantly using $10,000 of it, well, what that tells the credit bureau agencies is that there's a good chance you are going to run out of your ability to make your payments because you're using so much credit. So what they want to see is they want to see low credit utilization. If you've got $10,000, $15,000, $20,000 available to you in credit, they want to see you use $1,000 or $2,000 or $5,000, not the entirety of your credit that's available to you. Because what they say is that the number one indicator of whether or not somebody's going to get into financial trouble is the amount of credit that they've started to use. And obviously in Canada, this has been a huge discussion over the last several years where Canadian debt ratios are so high. And as a result, Equifax and TransUnion recognize this. And now they're giving that a higher factor in credit score algorithms to make sure that it's accounted for in somebody's risk profile. Now, this is a number that you can game. So the fastest way to increase your credit score is to play around with this credit utilization number. And the way that you do it is by making sure that you have less credit utilized. So ways you can do that is by paying down your existing credit or applying carefully for new credit. So basically the first strategy is to pay down as much credit as you can, and within 30 to 60 days, once you've paid down credit cards and lines of credit that you've utilized to a high extent, well, then your credit will start to increase. Now, the other way, again, is to apply for new credit. We typically don't want to see people apply for new credit unless they absolutely need it, but this is one way to kind of game the system. If you apply for a new credit card, a new loan, a new line of credit, that will increase your available credit, and ultimately, if you aren't using it, will help increase your credit score. Another thing you need to watch out for is if you're at high utilization rates and you start applying for more credit, well, what that tells the credit agency is that you're in trouble and you need more credit, and that will actually do more damage to your score than good. So that first strategy of paying down your credit always works. The second strategy of applying for more credit to get that utilization ratio changed up a little bit, that one can be dangerous and doesn't necessarily work all the time. In fact, it can do more harm than good. But let's say you get something like a pre-approval letter for a free credit card where they say no credit check required, or you get the ability to get a free credit card or a free line of credit with a mortgage or a bank account. Well, it's always a good idea to accept those offers as long as there's no fees associated with them, because that will increase your available credit and will ultimately increase your credit score, as long as you don't actually end up using those credit cards or lines of credit that you've been offered. Now, the third factor that goes into your credit score is your credit history, and this is basically how long your credit's been established. Now, a lot of the times we see people upgrading credit cards, getting new credit cards, and they have this, old MasterCard or this old Visa or something that they haven't used in 15, 20 years, and they go, I haven't used it because I've got a better Aeroplan card now, or I've got a better card that gives me better rewards, so I'm gonna shut down that original credit card. And that's a bad idea. What you want to do is you want to try to maintain your longest standing credit facilities. And what I mean by that is if you've got a credit card that you opened up when you were 18 years old and you've held on to it for the last 20 years, well, that 20-year time frame adds to your credit history, and that helps increase your credit score. Now, the fourth thing, and this makes up about 10% of your credit score, is public records. Now, these are things like collections and bankruptcies. Now, public records make up about 10%, but don't let that fool you. Because if you've gotten to the point where you've got a public record or a collection, there's a really good chance there's a lot of other stuff on your credit that's gone really bad. You've missed payments, you've got high utilization, and at this point, your credit is really bad, and it's probably gonna be a 7 to 10 year rebuilding process for you. So the key here is to make sure that there's never a public record filed on your credit. If you get a call from a collection agency, if you know you're getting behind on your bills, do everything you can to make sure that you don't have to declare bankruptcy, that you don't have a collection. And by the way, consumer proposal agencies will tell you that this is better than a bankruptcy. It won't affect your mortgage. It doesn't affect your credit as much. It does. It makes it as equally as hard to get credit as a bankruptcy does. They aren't good things. They do not help you. There are better options. If you can avoid a consumer proposal, do so at all cost. Avoid these like the plague. They are not a good thing, no matter what the consumer proposal company tries to tell you. If you absolutely have to, fine, do it. But don't think that just because you get a month or two behind on your payment and things are a little bit tough, that this is a good idea, because there's a really good chance that it's not. And the fifth thing that affects your credit, and this is probably the most misunderstood of the 5, is inquiries. And this makes up about another 10% of your credit score. And this is the reason why we are so adamantly opposed to credit card hacking, is because inquiries can hurt your credit and they can affect it quite negatively. And we have seen people on many occasions who have made every single payment, who have low credit utilization, but have a ton of credit cards and a lot of inquiries because they've done something like credit hacking, or people who like to go and shop for cars and go in every single month and let the dealerships run their credit. These types of activities definitely do damage to your credit. It doesn't matter what the experts on YouTube tell you, applying for credit when you don't need it is a bad idea unless you have no credit at all. Now, that's not to say that when you do need credit that you shouldn't go and shop for credit, because one of the things that we often see with clients is They feel like if they apply with us and then they apply with their bank and then they apply with another broker, that's going to do damage to the credit. Well, it won't, because credit bureaus and the algorithms are smart. What they realize is that when people go to apply for credit, that they should have the right to shop and that they probably will. So typically, if you're going and looking for a mortgage and you apply at several different places that have mortgage credit bureau pull codes, well, those pulls will all be counted as one rather than as 4 or 5. So you do have the right to shop, and shopping with multiple places will not affect your credit in a super negative way. You know, what will is if you apply for a mortgage every month for 12 to 15 months in a row. But if you're applying once and then maybe doing a recheck 4 months down the road to actually get the mortgage when you go to purchase a property, that stuff won't hurt you. It's when you apply over and over and over again for doing things like credit card hacking that you get hurt. The other thing to note is that there are things like soft and hard hits. When you go and ask for your credit from companies that do the free credit score monitoring stuff, when you ask for it from Equifax or TransUnion, or when your bank does a soft hit to see if you're still worthy of credit from them and to maybe make you offers in the future, those things won't affect your credit. What will affect your credit is when you apply for credit, when you apply for loans, when you apply for mortgages, when you apply for lines of credit or credit cards. Those things will affect your credit. However, a single inquiry isn't going to hurt you enough to drop your credit score from 750 down to 620. It might drop it a point or two. Now, let's talk real quickly about credit scores, because there's a lot of misinformation around this as well. What constitutes a good credit score in Canada? Well, anything over 680 is considered good, and that will pretty much get you the best rates, the best options, the best debt servicing ratios across the board. So if you've got over a 680 Beacon score, you're probably going to be okay. Between 620 and 680, that's where things get a little bit iffy. You may not be able to qualify for as much. Will you pay a higher interest rate? Probably not. Most companies don't charge a higher interest rate between 620 and 680, but it's a possibility. Now, under 620, this is where you start to get into issues. This is where it starts to become hard to get a loan. And because it's hard to get a loan, the price goes up. That's where you start getting charged a higher interest rate. If you're between 550 and 620, can you improve your credit score and get it back up into that 650 to 700 range? Yes, it's definitely possible. Once you get below 550, you've probably got a lot of work to do, and it's probably going to be a matter of making sure going forward that you always make your payments on time and making sure that you do so for at least a 7 to 10 year period, because once you're under that 550 Beacon score, it's probably going to take a lot of time and a lot of effort to get your credit score back to where it needs to be. So to round this whole thing out, what are the things you can do to make sure your credit stays good? Well, first of all, avoid missed payments, avoid consumer proposals, avoid collections, avoid bankruptcies, basically avoid anything that has to do with missing a payment. The second thing is make sure you keep your utilization rates low, so borrow far less than what you have available to you. The third thing is don't shut down those old credit cards. They are helping you. By the way, don't shut down any old credit cards or any lines of credit, because the longer you have them, the more available credit that means you have, and the better your credit score will be. And the fourth is don't apply for credit you don't need. If you've got a good credit score, if you've got all the credit that you need, don't apply for more. There's no point. Now, if you've got under $2,000 in credit cards available to you and you've had less than 2 years history on them, does it make sense to maybe apply for another one and get a little bit more available to you? Absolutely. But outside of that, there's really no reason to apply for a loan that you don't need or a credit card that you don't need. And sure as hell, don't do credit card hacking. That's just silly. So if you found this video useful, if you found it interesting, if you found you learned a whole bunch about credit that you didn't know, do me that favor. Hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. This is definitely an important one. And please, please, please do me that other favor. Comment in the comment section below. Ask me your credit questions, leave me your credit comments, and we'll see you on the very next video. Cheers.